Good afternoon and welcome. You're watching Bloomberg Quint Live and these are the headlines at 12. It's been a tough start to the week for both the benchmark indices as they continue to extend losses. India VIX surges. 50 individual stock futures start trading on the Singapore Stock Exchange from today. And it's a two-way race for Bhushan Steel, as Tata Steel and a JSW Steel-led consortium are the only bidders to submit final bids. And Bosch and Tata Motors are the two nifty companies coming out with third quarter earnings today. Now it's over to your host for Hot Money, Darshan Mehta. Darshan?
Thank you, Alex. Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts then. Independent advisor Vivek Mavani, Senthil Manikandan of Newberry Capital and Ashish Chaturmohta of Sanctum will join us on the show. Thank you to all for joining me on the show. Today on Hot Money, we'll discuss stocks like Bajaj Auto, Dewan Housing, Inox Leisure, and we'll ask our guests for a large cap pick. Let's start with the first one, and that is Bajaj Auto. Numbers came out on Friday, came in below what the street was anticipating. The counter did manage to correct 6%. Today also the trend seems to be on the downside. It's up down almost 1.5%. So what should one do with Bajaj Auto and what's the view going ahead? We'll ask our guest. Senthil, I'll start with you. What did you make of Bajaj Auto's numbers and what do you think should one do with Bajaj Auto now?
So, particularly in Q3, we have seen improvement in their exports. This is because of the base effect. Basically, because of the crude prices are increasing, their export markets have been performing well. And we have seen improved performance in their commercial vehicles, that is the three-wheelers. They are the market leaders in India, so the performance has been good because it's again the base effect. But one pain point with Bajaj Auto has been they are consistently losing their market share in their domestic motorcycle. So if you see last 3 years, their market share has declined from the upwards of 20% to currently 16%. So this is because of their new models hasn't been growing and there has been no any path-breaking models from the company. So, but what the company is doing now is they have once again increased their focus on the entry-level segment. This could in turn bring volume growth, but at the same time it may impact their margins. So in Q3 also we have seen their margins have been declining below 20% for the last 3 years. We haven't seen they have always maintained their margins between 20-22%. And this is one reason. And second reason could be the increase in raw material costs. We have seen steel, aluminium, all these prices have inched up year over year. So, but what I'm seeing is with the current market share around 16.5% in the domestic motorcycle, I think it could be a bottom. And from here on, the company could inch up. If you look at the valuations also, it is trading at around 20 times 1 year forward earnings, and with a strong balance sheet, they have a cash of around 15,000 crores. And if you remove cash, and the market cap is around 93,000 crores. So on operating level, the company is trading at around below 20 times. And with a strong management pedigree, so we are neutral to bullish on the stock.
Okay, so it's a bullish view that's coming in on Bajaj Auto. Vivek, could you echo the same sentiments on Bajaj Auto?
Oh yeah, absolutely. I could second what Senthil mentioned. Basically, after almost 5 years of lackluster performance, challenges on volume growth, challenges on profit growth, last 3 quarters what we have seen is a bounce back in in volumes by double digits. So I mean we have had a 25% growth in exports in volume terms. I mean our total volumes grew by about 18% across exports to motorcycles and commercial vehicles. Commercial vehicles I believe grew close to 30%. Commercial vehicles also the most profitable segment, and partly linked to the economy as well. I think the worst is over as far as Bajaj Auto is concerned on the performance front. Even in the third quarter numbers which came on Friday, if we look at, on a flattish profit after tax was actually a result of higher tax payout and lower other income. So if we look at EBITDA, EBITDA growth was 18%, the operating EBITDA. Interest depreciation, there's hardly any interest, depreciation is marginal. So, I'm sorry. So basically in terms of operating performance, it's been a fairly strong performance. Yes, concerns on loss of market share and all that is fine as long as they maintain the double-digit trajectory in terms of volume and profit growth. I have no issues. I think it's a terrific buy on declines story over the next 2 to 3 years. Valuations are supportive at about 17-18 times next year earnings, with about 17,000-18,000 crores of free cash sitting on the balance sheet. One of the highest free cash flow generating companies that we have. So I think every decline is a possibility to accumulate.
Okay, so it's a 2 thumbs up that's coming in Bajaj Auto. Ashish, what did you make of the numbers and how does the stock look?
So it looks very positive. You know, first of all, Darshan, if you look at technically also, the stock has been in a consolidation for last couple of weeks and months, and I think going forward we are going to witness a good amount of momentum. Now, if you look at in the fourth quarter, we are expecting a double-digit growth, and in terms of, you know, they have a 2 new launches in 125cc and 400cc. So I think a good volume growth could be seen from current levels. In terms of, you know, three-wheelers domestic sales, they are a strong leader, and obviously with the easing out permit system in the Maharashtra and replacement demand in Bangalore, I think it's going to be very positive for the stock. As we saw the numbers, you know, this was there was a growth was less because of the effective tax rate, which was comparatively higher, but we believe that going forward you can see a good 15 to 16% kind of upside in the in terms of volume as well as sales in the sales. So I think we expect good 20 to 25% kind of upside from current levels in Bajaj Auto.
Okay, so it's a consensus positive view that's coming in on Bajaj Auto, despite the numbers coming in slightly below what the street was anticipating. The next stock that we'll talk about is Dewan Housing, and one of the counters which has seen a big knock, at least in the housing finance space, is down almost 20% from the recent highs. It's trading even lower today. It's down 1%. What's the view going ahead? One of the cheapest stocks as far as the housing finance play is concerned. So what's the view here? Vivek, you go first. Any view, Dewan Housing?
Basically, nothing wrong with Dewan Housing too. I mean, a point which you made, it's the cheapest, but it has always traded at a, over the last 5-6 years, it has always traded at a discount to other peer group housing finance companies. But in terms of actual performance, financial performance, I think they have done a fairly good job of growing earnings year after year, quarter after quarter at more than 20%. Even the third quarter numbers, I mean, there was a 25% growth in profit after tax, after provisions and all that. Net NPAs at less than 1% have been maintained. And of course, a book size of now upwards of 1 lakh crores, which is of some meaningful size. My issue with nothing specific to Dewan Housing or to be bearish, I'm basically bearish on the entire sector of housing finance space. So that includes the other companies also. I have mentioned that for India Bulls Housing Finance or Grow Finance in the last few weeks on this very program. So my issue is that housing finance has had a terrific run over the last 5 years in terms of both operating performance of each of the companies doing very well, plus the stock price also. They have got massively re-rated as well. I think now the challenge is in terms of squeeze on margins, accumulation of bad loans, and I think everybody's in this affordable housing space, and I think that's going to be a minefield over the next 2 to 3 years. I mean, something I would say something to watch out for. So the reason I would be neutral is I wouldn't buy any housing finance company, barring an HDFC, the largest of the largest and the best. All others I would simply avoid.
Okay, so that's the view that's coming in on Dewan. Ashish, what did you make of Dewan Housing?
So individually I'm comfortable, but the only challenges with the rising yield is a little negative for the entire basket, as Vivek was mentioning. But if you look at individually, you know, company is present in a lower ticket size loan and into tier 2, tier 3 cities, and it's a key beneficiary of government's thrust on the affordable housing segment. So I think, and as we were discussing, 2 times price to adjusted book value, it's the cheapest, and with return on equity potential of more than 15% in next 1-2 years. I think it's fairly valued, but the challenge is with the entire industry. Until we don't see a clear reversal in the yield curve, I think we are going to see a challenging times, at least in a short to medium term, in most of these names.
Okay, so that's the view that's coming in from Ashish. Senthil does not track the company and does not have a view on the counter, so we'll move on to the next stock, and that is Inox Leisure. Has been doing well, you know, and when the market has corrected significantly, this counter has managed to stay up. It was down, it's up almost 5 to 6% this week, and today also trading with a positive bias. So what's the view for Inox? Hasn't been a marked outperformer though. 12-year returns of 25% when others have given much more returns. But what should one do with Inox Leisure? We'll ask our guest. Vivek, you go first. Inox Leisure.
Well, as far as a sector, again, here it's a sectoral call. It's so when we discussed PVR a few weeks ago on this very program, my issue with both Inox and PVR and basically this whole business of entertainment is low return on capital and low return on equity. Versus that, I mean, valuations which are upwards of 40 times earnings for current year or even next year. I mean, whatever numbers you take. I mean, not a very meaningful difference. On the growth front, I don't really have an issue. I mean, rising penetration to tier 2, tier 3, tier 4 cities, aspirational levels, consumption growth, all of that is fine. But I think this low return on capital and low return on equity is not a cyclical phenomenon. I think now I'm convinced after 10 years of having seen the sector, I think it's structural. So I mean, few years ago, I mean, both the companies would say, oh, when we have the scale, I mean, both of them are at 500 plus screens. PVR probably will be approaching 1,000 screens in the next 12 to 18 months, and yet return on capital and return on equity barely even touches 10%. So that clearly, I mean, the low returns, negative cash flows clearly don't deserve these kind of valuations as far as the consumption space is concerned. So the P&L account will keep growing, but I think the balance sheet will keep growing disproportionately. So basically, I'm again negative on both the companies. Both the if I have to play the consumption story and the same factors which drive this, there are a whole lot of other better companies available.
Okay, so you're bearish on the entire sector as such. You don't think
absolutely. I'm bearish even on PVR. I mean, so is Inox. I basically bearish in the sense I'll just avoid buying. That's simple as that.
Okay, so that's the view that's coming in. Ashish, what did you make of Inox Leisure?
So I have a little contra view. We are a little positive on the entire film exhibition business. You know, first of all, it's a oligopoly nature in terms of the industry size. So top 4 players contribute 70% of the business, and you know, with the expensive mergers and acquisitions, you know, there is a little scope for any new entry in this entire industry. So I think yes, it's a little expensive, but what we believe is that in next, you know, coming 2-3 years, we expect 5 to 10% footfall growth, which will lead to a revenue CAGR of 10 to 15%, and that will lead into a higher profitability. So going forward, yes, we are positive. I think yes, definitely one has to buy on dips, but if someone is having a view of more than 9 to 12 months, then I think definitely a good 20-25% kind of candidate is the stock. Only volatility is induced by due to the content, and you know, the content is a big risk, but I think that risk is also to a lot of extent is mitigated by the Hollywood content and the regional content in the local language as well as into the dubbed side. So I think broadly most of this risk is being taken care of. Going forward, we might see good amount of upside.
But you are comfortable with the valuations as
I mentioned, valuations are little expensive, so one has to buy at current levels and use any dip towards 7-10% to average on the positions, because we believe that going forward we can see a good amount of upside.
Okay, so it's a positive, it's a one negative view, one positive view on PVR. What did you make of it? Which side are you on?
So we are also neutral to bullish on the stock.
Okay.
Basically, because in the last 10 years, what we have seen the industry wide, there has been a lot of consolidation has happened. So now the top 4 players secure nearly 3/4 of the market. So going forward, especially the exhibition industry, the location has been a major important factor. With these top 4 players securing majority of the prime locations, so no new players can come in and like what happened in the telecom sector. Like Jio came in and they threshold all the existing players, but this cannot happen in this sector because real estate forms a major and prime locations result in higher footfalls. That's one major thing. Second one, with respect to the company, Inox currently they are operating around 500 plus screens, and they have been adding around 45 plus screens every year. And we can look at the entire exhibition center, their occupation ratio is around 29%, 30% kind of thing. But going forward, this could increase. So the fixed nature of the business, once the top line grows by around 10-15%, we will be seeing substantial growth in the bottom line. So current valuations may appear expensive, but going forward, once the occupancy rate improves from around 26% to the kind of 29-30%, the entire increase in the top line will flow to the bottom line. So we are just positive on the entire sector itself.
What did you make? Because Vivek had a concern in terms of low return ratios. What is the thing there? Do you believe that these these will remain at such levels, or do you see an improvement going ahead?
So we see improvement going ahead. Like you mentioned, last 5 years or 10 years, there have been a lot of consolidation, acquisitions happening in the sector. Plus, going forward, like I mentioned, the operating revenue will grow faster than the top line. So, and this flow directly to the bottom line. Once the bottom line improves and considerably grows, automatically the ROEs and ROAs will improve. So, we see from the current levels of 5 to 6%, it could improve to 11-12% in the next 3 years.
Okay, so it's two positive views that are coming in on Inox Leisure, while Vivek has a negative view. Before we move on to the large cap picks, here's a quick recap of all the guest views on the stocks that we've covered till now. Okay, so there's this big correction that's happened in the market. Some of the large caps have corrected significantly, some of the mid caps have corrected significantly. So we're asking our guest to tell us one large cap pick that our viewers should accumulate more as a positional trade, which could give them decent returns, and use this fall as an opportunity to accumulate. So Ashish, you've selected Tata Elxsi.
Yep.
What's the logic?
So Tata Elxsi looks very strong to me. First of all, I'll put a technical perspective to the stock.
Okay.
It made its high somewhere around 12-15 last 1 year, and now post then it saw significant correction, and now it's in an upward trajectory. We believe that the kind of structure we are witnessing, stock has a potential to deliver at least 30-35% kind of returns from these levels. Now this could be reflected in the numbers. We saw
this
revenue.
Is a technical view. That
this is a technical view, and if you look at in terms of data, 11% growth in terms of top line, and the margin expansion was to the tune of 400 basis points, jump to the tune of 27.1%, which is significant. So keeping that in mind, I think, and the strategy to focus on building a portfolio of IPs that would enable higher contribution over the next couple of years, and they are reducing their dependency on the selected few clients. So that is also going to have a positive impact. So we believe that this is one stock within, and it is also into the futuristic technology. So I think going forward, Tata Elxsi has a potential to deliver 30-35% kind of returns.
So what are the valuations?
So it is little expensive if you look at in terms of PE side, it's somewhere around 24-25%. But the kind of margin expansion we are seeing, that will put a lot of re-rating in terms of price performance.
Okay, so Tata Elxsi seems to be the choice that Ashish has selected. He sees a potential 30-35% upside on the technical side, and even that is supported by fundamentals. Valuation no doubt are slightly on the expensive side. But Senthil, you selected BSE, and as a disclosure you said that your company owns a stake in the company, but what's the rationale for BSE?
So if you see, let's take a macro view.
Yes, sure.
Currently the GDP is around 2 trillion. So everybody is of your opinion like next 15 years or 20 years our GDP is going to grow about 8 trillion. Our market cap tracks GDP. So once market cap GDP grows, automatically market cap also grows.
Sure.
And as a investing community, we always look for companies that have a sustainable competitive mode and it can sustain over the years. We have seen since the inception of the index like Nifty or Sensex, there have been a constant churn in the companies. Like since Nifty inception, we have seen 180 companies coming in and coming out. So instead of focusing on finding companies which can maintain, which can at least sustain for next 10 years, we see exchanges will be there like for next 10 years, 20 years, whether there will be a lot of companies coming in and coming out, but the stock exchange will be, business will be there and it will be up and running. And it the market cap tracks the GDP. So on the overview, we are positive on the exchange business as per se. And coming to BSE, we see that BSE has been the second level player compared to NSE. NSE are the market leaders. Especially in the cash segment, BSE's market share is just 13%. So from here on, we see there is no further downfall. And BSE has been it is on par with the NSE in the currency derivatives. While the equity derivatives, it's completely the NSE. So from here on, what you're seeing is that BSE has nothing to lose, and we have seen the BSE came into IPO last year at a market price, at a IPO price of around 800, 805, and it went up to 1,200 kind of levels, and now it's back to around 820 levels. So if you look at the current market cap is around 4,600 crores, and the company owns cash of around 3,000 crores, and they have a 24% stake in CDSL. So if you put together, there is around 3,650 goes out. So the entire business franchisee of BSE is valued at around 950 crores. This also includes their international exchange at Gift City. Plus, there are a lot of other platforms like their mutual fund platform and SME platform. These are yet to be monetized. So these will be the growth drivers coming in. So we are just positive on the business per se, and also valuation also look attractive at this market price.
What's the valuation at? What is it trading at?
So it's trading, if you look at the multiples, it's trading at around 20x FY18 earnings. But on the if you look at the P&L, you have to segregate the revenue of operating income plus their income coming from their financial income. Now what you're seeing is last 3 years their operating income have outgrown their investment income. So for FY18, if they post a revenue of around 600 crores, 400 crores will come from the operating income and another 200 crores will come from the financial income. So going forward, we see their operating income is enough to sustain their operational expenses.
Okay.
So entire financial income will also flow into their bottom line.
Okay, so that's the view that's coming in on BSE. What's the risk here? If NSE list, will this still remain as an investment bet? Because right now, in terms of only in currency derivatives, it's higher.
Yes.
The rest, it's pretty much negligible. So is that a risk that would be there on BSE?
So especially we have only 2 exchanges, like it's a duopoly market currently now. So even if NSE list, we need a second exchange like that. And current valuations, I think it's 20x for a business franchise as BSE. It's attractive.
Okay. So that's the view that's coming in on BSE. And Vivek, what are you betting on as far as the large caps are concerned?
See, basically, for where we are at this point of time, I'm bearish on the markets, and I think this correction is going to go much longer. I mean, almost a 35% rise over the last 14 months, more than 3,000 points on the Nifty. The correction can't end with 300-400 points decline in Nifty from the top, or maybe even 500 points decline from the top as far as Nifty, or 5% is what we have roughly done. The correction is going to get much deeper, not necessarily with few hundred points fall immediately, but I think market is going to be grinding, creating lower tops, lower bottoms, as you would call in technical parlance, over the next 3 to 6 months. So more than stock pick, I mean, I would refer to a strategy of basically taking profits where we have increased cash levels in the portfolio and move to low beta large caps. So there the kind of names that come to mind are Asian Paints, HDFC Bank, ITC, Mahindra and Mahindra, a TCS also, TCS Infosys, I mean basically large cap IT, Sun Pharma among the large cap pharma, including Cipla. So across the board, that's what I would do. Move the portfolio to large cap, low beta. Low beta is the key word. Stocks which have not had a very sharp run up in the last few months are probably the preferred bets, because they are unlikely to fall majorly. I mean, they didn't participate much on the upside. It's unlikely that they'll have a full participation on the downside, very unlikely. So it's largely about that strategy. I think it's still too early to be doing stock picking or trying to catch the bottom. I think the bottom is still a while away, both on the time frame as well as on the levels.
Okay, but among the large caps, which would be your top 1 or 2 stocks? You've named several, but 1 or 2, and why?
I would pick ITC.
And what's the reason?
Basically, again, ITC is a terrific earnings compounding machine, as well as free cash flow generator. Growing at about 15% or 12 to 15% growth is something that one can very safely assume in ITC. Valuations have not run up as much as in terms of expansion of multiples over the last 3-4 years, the kind that we have seen in the overall consumer space. ITC did not really have that kind of a re-rating. So I'm assuming even the de-rating will not happen, because the larger risk for the whole market across the board is de-rating and compression of multiples. So where multiples didn't expand in the first place to a thing that they'll compress now, I think is a slightly far-fetched thought. So ITC for me is the safest bet at this point of time.
Okay, so Vivek is saying that move your portfolio to a bunch of large cap pick, but his biggest allocation probably, if you want to do, would be in ITC. Senthil is bullish on BSE, while Ashish has recommended Tata LXC. So with that, Ashish, Senthil and Vivek, thank you so much for joining me on the show. With that, it's a wrap on today's Hot Money. Ask BQ comes up next. Stay tuned to Bloomberg Quint.